Welcome back, and joining me with more insight on the day's trade is Yatheen Singh from Momentum Securities. Yatheen, thanks so much for your time today. Now let's start things off looking at some economic data. US GDP out yesterday, growth there coming in at 3.3% for the second quarter. Now this is the second estimate and it has of course beat forecast. Talk to me about what you made of that print and whether you expect to see the same kind of growth trajectory moving forward.
Second quarter US GDP was revised up to 3.3% on a quarterly basis from 3% previously. And I think to a large extent what we are seeing within that economy now are signals of higher or rather stronger private consumption and a significant upward revisions within business investment, particularly within intellectual property and equipment. Now, another key metric to look within that report has been the gross domestic income, and this has also rose sharply to the vector of 4.8% on a year-on-year basis. And to a large extent, this was driven by a plethora of one-offs, firstly including federal tariff sort of revenues or spike in federal-induced tariff revenues. Now, this may distort the true picture of the economy and the actual momentum, because we are in a fairly contrarian market at the moment, where we are seeing corporate profits start to exceed economic growth. And well, I wouldn't say start to, we have been seeing that picture for the past 3 to 4 years now. I mean, obviously ex-stimulus. But in terms of looking at this picture now and what that means for the economy's growth trajectory forward, I think we can assume that there will be a heightened pace of treasury borrowing going forward. And secondly, with regards to policy easing and what we can expect in the FOMC meeting in the upcoming 19 days is actually a much needed pace of lower interest rates.
And that was going to be my next question around what we could possibly see from the Fed in those 19 days, considering what we are seeing in the labor market, what we are seeing when it comes to inflation as well. But yeah, we're crossing fingers, crossing toes that the Fed does cut rates, and that might, trickle through to the SARB. And sticking with monetary policy, we did get those minutes out of the ECB. Policymakers there saying that risks to inflation is balanced. Just with that in mind, how have you read those minutes? Does this mean that we could see even more rates moving into the end of 2025?
I think you hit the nail on the head there. I think most members have voted unanimously to keep that the economy's long-run rate constant at about, or rather unchanged at 2% within that 28 to 29 of July meeting. And I think to a large extent, it has been because they are viewing the inflation risk, as you mentioned, as balanced, but also there are no fairly fewer exogenous or once-off structural risks to that economy's sort of inflation outlook. So in terms of looking at the potential downside risk to inflation, that's much lower. Also, the Eurozone economy remains fairly resilient despite these external pressures and exogenous shocks that are coming from tariffs. As we know that the US effective tariff rate is currently at 16%, right? And in terms of how they are likely to fluctuate, that depends on terms of trade. And again, it's also the efficiency of supply chain surrounding the goods traded. So I think to a large extent, the Eurozone economy has been on the better end of that trade, as opposed to peer economies such as China. So I think to a large extent that will benefit the Eurozone in the long run. But what it does mean is that we are likely to see less interest rate cuts, at least for over the next 12-month period.
All right, let's move over to some company news. Northam Platinum out with results today. Profits coming in lower, with HEPS down 14.4%. I mean, that's expected, right? Considering what market conditions look like over that period, we did see lower platinum or PGM prices, and generally, really a tough economic environment.
Yes, so I think Northam did deliver a fairly mixed bag of numbers for the 12 months to June. But the recurring theme for Northam, for us particularly, has always been that there have been material improvements within the operational side of the business, so that obviously impacting the bottom line. But we haven't seen any material benefits see through towards the top line. And again, as pressures towards that cost curves and free cash flow continue, that does diminish, not only debt quality, but also that overall leverage towards the pricing and their gearing to the PGM basket. So if I have to touch on two key figures quickly, firstly being the net debt, which did suffer from, or rather, which did increase to about 5.1 billion rand, and this did come on the back of a fair degree of once-offs. So that does now take their gearing significantly higher from 0.5 times in terms of the net debt to EBITDA, now just above 1. But this was, as I mentioned, impacted by a fair degree of once-offs, including a once-off increase in the issuance of domestic medium-term notes. And then secondly was the capex figure, which was up roughly 7% on a year-on-year basis. Again, we are seeing ongoing ramp-ups in production at Eland. And then again, in terms of looking at the entire free cash flow story, with that still being negative, I think with platinum and palladium still going into a structural deficit into FY26, and the rhodium supply also remaining in a fairly tight position, I think that one wants to be positioned within the sector, but with those that, or rather with counters that have a more favorable leverage towards the PGM basket. And for me, this has been Impala Platinum, if one has to look at their results, which was much more fairly received by the market, and Voltira on the back of its quality.
All right, let's get to your stock pick then. Where are you seeing opportunity at the moment?
Yes, so I believe that valuation discounts to historic multiples, trough margins, and over 13.5% earnings CAGR over the next 3 years within the discretionary retail sector pretty much sets the pace and the tone for it for a much needed structural and cyclical based recovery. And this argument is specific to the clothing apparel space, as we also don't believe that we have fully seen the lagged impacts of lower bond yields and lower interest rates see through to profitability just yet. So my pick is Woolworths Limited. Now, firstly, because there is a fair degree of misconception and or overstatements in the market surrounding their fashion, beauty, and home business segment, I believe that their FBH business segment is due for a turnaround. As we are coming during a period of time where we are seeing supply chain efficiencies through higher working capital outlays, higher stock turns, and an improvement in their overall group operating leverage, which obviously implies higher GPs in the longer run, come through from more of a reduced cost base, and this is highly beneficial to the firm. Now, it's also worth noting that the FBH business has a very traditional private label skew. So the recent changes made to the business, I mean, by the business's management, I think that it was much needed, albeit coming through pretty late. But it's starting to result now in a more sustainable position, not only from a balance sheet perspective, but also from a profitability perspective for that business going forward.
All right, let's leave it there then, Yatheen. Thanks so much for your time and just taking us through markets action today. Now, that was Yatheen Singh from Momentum Securities.